I regularly receive emails, comments, and private messages from folks asking me how I make money using stock options. So in this video, I'm going to reveal the 5 option trading strategies I use to make thousands of dollars, so that you can also use these same techniques to make your thousands or even millions of dollars yourself. Hi and welcome, I'm Jim Ray and this is my Simple Option Trading channel. Folks want to know how I'm making money with options trading. So I'm going to share my blueprint for my options trading business success. And that's exactly right. I treat this just like a business. So I use specific tools, I have tactics that I follow, and a very specific process. And that allows me to be successful. So not only do you get to find out what my strategies are, I'm going to share with you how to use each one to make money. Plus I'll add some examples along the way. Because who doesn't like to see how to make money? Because it's not only about covered calls and cash secure puts. I've got 5 other strategies that I also use to make money. So if you want to make money like me with options trading, stick around and watch this whole video. So let me first start with one of the simplest and easiest ways to get started with options trading, and that's by doing something called selling a covered call. I'm going to use myself in this example of selling a covered call. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date. And I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now that I showed where a covered call option contract originates from, let me now share a fictitious example and walk you through a covered call option trade. We start off with me on the left and the stock market with buyers on the right. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer then takes ownership or is retained or is associated with the option contract. At this point, now I have to sit and wait for the expiration date. And now let's skip forward 30 days to the expiration date and look at what happens. It's going to be one of 2 things. So the first result is the market price finishes above the strike price. So in this case, the option contract is going to be exercised, and so my shares will get assigned to the buyer, and I'm going to receive payment for those shares, and I get to keep the premium. Now the other result could be that the market price finishes below the strike price, in which case the option contract is going to expire worthless. And I'm going to retain the ownership of those shares, so I don't have to give them up. Plus, I keep the full premium that I received for selling the option contract. So let's now take a look at the 2 possible results from me selling a covered call option contract. Outcome number 1 occurs when the market price finishes above my strike price, in which case my shares will get assigned to the buyer, and in return, I'll receive payment for my shares based upon the strike price. Additionally, I will keep the full premium payment that I received for selling the option contract in the first place. The second outcome happens when the market price finishes below my strike price on or before the expiration date. In this case, the option contract will expire worthless. And as a result, I'll retain ownership of my shares. These are the shares that were reserved as my collateral and allowed me to write the covered call in the first place. Additionally, I'll keep the full premium payment that I received for selling the covered call. Okay, great. Now we know how a covered call works and how to make money from them. Now let's move forward and take a look at how I plan to apply this strategy. And then I'll share a real-life example where you can see my results and the profit I made. My strategy for selling covered calls to make money is pretty simple and straightforward. First, I plan to utilize the shares that I already own in my portfolio for the covered call options. Next, I'll sell a covered call using the shares that I have as collateral. Then after the option is sold, I'll monitor the option contract so that I'll know which money-making exit to implement. So first, I could let the option be exercised and profit from the price appreciation in addition to the premium I've already collected. Or I can let the option contract expire worthless so that the shares and collateral are released back to me, and I also get to keep the full premium payment that I received. Or lastly, I can just buy back the option contract to remove the obligation to sell my shares, and I still get to keep most of the premium payment that I've already got paid. So what I really like about this strategy is I sell one covered call, but then I have 3 different ways to make money. Well, now it's time for me to share a personal real-life example using my own personal trading account where I currently hold 100 shares of stock that I'm going to be using for selling this covered call option. Earlier this year, I acquired 100 shares of Enphase Energy Incorporated, stock symbol ENPH. And now, I'm going to use those same 100 shares as collateral to sell a covered call. Here's the transaction record from my account history from when I sold a covered call using 100 shares of Enphase Energy that I currently hold in my portfolio. You can see from this transaction record that I sold a covered call using my shares of Enphase, stock symbol ENPH, with a $175 strike price and an expiration date of February 11th, 2022. Now, I submitted the order on February 8th, and it was filled that afternoon at 12:59 p.m. Pacific Time. Now, at the time that I sold this covered call option contract, I received $2.50 per share as a premium payment. And so when this option contract got filled, I received a total premium payment of $250. In order to track my progress and profits in this video, I created a simple worksheet so we can keep track of everything. So here you see this first covered call that I sold on February 8th that had the February 11th expiration date, and I received $250 as the premium payment for this 3-day covered call option contract. Now let's take a look at a daily stock chart and zero in on February 10th, 2022, a couple days after I sold this option contract. And we could see that the share price had dropped appreciably from the previous day. In fact, on February 10th, the stock price closed out at $154.64. Now, because the stock price had dropped so much, in fact, it had gapped down. You can see that the price had gapped down. The option price had dropped as well. So I decided at that point to buy back my option contract and close it out using a buy to close technique. Now, if you're not familiar with a buy to close technique, it's actually a pretty simple concept to grasp. All I'm doing is purchasing back my option contract that I had opened initially when I sold the covered call. So here you can see the transaction record from my account history where I actually purchased the option contract back. So I'm buying back my option contract for ENPH that had the $175 strike price and the February 11th expiration date. You can see here I submitted the order to buy to close on February 10th, and it was filled that morning at 8:36 a.m. Pacific Time. Now at that time, I needed to pay 25 cents per share in order to close this option contract. So when this buy to close was executed and filled, I ended up paying a total of $25 to close out this option contract. So with the buy to close completed, let's update my spreadsheet so we can see how I'm doing. So on February 10th, I used a buy to close on that covered call that I originally sold that had the expiration date of February 11th. Now I had to pay 25 cents per share, or a total of $25 to close out this option contract. So that made my new account balance $225. So buying back my covered call option contract that I originally sold is in essence saying I'm no longer interested in making that deal. So I'm paying back or buying back my option contract that I initially sold. And what that will do is it'll make that contract go away. The shares that were reserved as my collateral now become released and allows me to keep those shares so I don't have to worry about them being assigned if the option contract were to be exercised. But now that I have those shares again, I can actually turn around and sell another covered call. Now, of course, the downside to buying back my option contract is that I have to actually pay money to do that. But as you saw from the worksheet, I received $250 for selling the covered call, and I only had to pay back $25 to close out that option contract. So the net effect is I walk away with a net profit of $225. Well, now that I've closed out that covered call option contract, my shares are no longer obligated, and I'm free to do whatever I want with them. I could continue to hold them, or sell them, or trade them. And so that's one of the great things about this particular options trading strategy. By selling covered calls and then buying to close the option contract, I retain ownership of those shares, and now I can sell them again in another covered call and be able to collect even more premium payments. And I can do this over and over again. There's no limit. Well, next up is another one of my favorite money-making strategies, and it's called selling a cash secure put option contract. I love selling cash secure puts for income, and it really comes down to just 3 simple steps. In step number 1, we pick a good stock that we're going to use as the underlying security. In the second step, we actually sell the cash secure put. And for the last step, step number 3, we simply manage the trade. But before I show you how I make money with a cash secure put, I think I need to explain what a cash secure put is and how exactly does it work. Give me a few minutes and I'll define and explain what a cash secure put option contract is. So what is a cash secure put option contract? Well, you can think of it like this. It's a contract between two parties, a seller and a buyer, that defines an agreement to trade an underlying security at an agreed upon price during a specified time frame. So don't try to memorize or understand that. I'm going to break it down for you step by step so it's easier for you to understand. So you start off with the option contract itself. So this is a cash secure put option contract. And the first thing to note is that one contract controls 100 shares of stock. So then if you have two contracts, it would be 200 shares, 3 contracts, 300 shares, and so on. So for our demonstration, though, we're only going to be dealing with one contract. So that's 100 shares. Next, each contract has an underlying stock associated with it. So for this example, we're using a fictitious company called ABC Incorporated, and its shares of stock will be associated with this option contract. Like most contracts, there's an expiration date, and that's used to define the length of the option contract itself. So it could be 1 week or 1 month or 1 year. It just depends on what the seller chooses for the length of the option contract. And then the last component is the agreed upon price for the trade of the underlying stock. And this price is known as the strike price. As I mentioned, this option contract is used for trading an underlying stock between a buyer and a seller. And that strike price, that defines the share price that'll be used for the transaction. Now you have the basics of a cash secured put option contract. Here's how selling a cash secured put option contract works. So pictured on the screen is the seller, and on the right hand side we've got the stock market at large. Now as I mentioned, the seller is the one that actually creates and sells a cash secured put option contract. And the reason why they're able to do this is because they have money reserved as collateral for the option contract. So what is the collateral? Well, it's the money that's used by the seller if they need to purchase the shares when the option contract gets exercised. So as a part of that agreement of the option contract, if that contract gets exercised, the seller is obligated to purchase those shares at the strike price. And so that's how you calculate the amount of money required to be reserved as collateral. You can calculate it as follows. You take the strike price and you multiply it by 100 shares. Remember that I said that each contract is equivalent to 100 shares. So if you had 2 contracts, it would be the strike price times 200 shares. But for this example, we're looking at one contract. So to calculate the collateral, you take the $50 strike price, you multiply it by 100 for the 100 shares, and so the amount of collateral needed to be reserved by this seller when they sell this option contract is $5,000. Now, once the seller has the money reserved as their collateral, they can now advertise and sell the cash secure put option contract to the stock market at large. And interested parties will see this option contract being placed for sale. Now, an interested buyer is going to indicate that they want to buy the cash secure put option contract from the seller. And in order to do that, they need to pay the premium for the option contract. And the premium is just money used to purchase the option contract. So the buyer pays the seller the premium for the option contract, and in return, the buyer will now own the option contract, and as a result, they'll have the right to exercise the option contract at the strike price on or before the expiration date. Now for the seller, they're going to receive payment for that option contract, so it's an exchange of an option contract for some funds known as the premium. Now we're ready to take a look at what happens on the expiration date of the option contract. There's 3 possible outcomes, and in this first outcome, it's where the market price finishes above the strike price, and this is called out of the money. So you can see from this example, the market price closed at $58, and our strike price was $50, so this is out of the money. This next outcome is called at the money, and it occurs when the closing share price exactly matches the strike price. The market price closed at $50, which matches exactly with the strike price, and this is called being at the money. And this last outcome is called being in the money, and it's where the market price finishes below the strike price. So if you can see from this example, the market price closed at $45, which is below our strike price. And so this option is considered in the money. Well, now let's take a look at what happens at each of these possible outcomes. Out of the money, at the money, and in the money. So when the cash secure put option contract finishes out of the money, it means the closing price finished above the strike price. And as a result, the option contract will expire worthless, and the money reserved as my collateral gets released back to me and returned in my trading account so I can use for other trades or withdraw it or use it for any other purpose. And all the premium that I collected for selling the option contract, I get to keep the full amount. For the second outcome, where the option contract finishes at the money, it means that the market price closed at exactly the same price as the strike price. And as a result, the option contract expires worthless. The money that was reserved as my collateral is released and returned back to my trading account, and all the money I received as premium, I get to keep. And the third possible outcome is where the option contract finishes in the money. And in this situation, the market price closes below my strike price. And as a result, the option contract gets exercised, and the shares now get assigned to me as the seller. The money that was reserved as my collateral is used to pay for those shares, and I still get to keep all of the premium that I received for selling the cash secure put option contract in the first place. All right, now that we have that background and an understanding of how cash secure put options work, let me share with you my overall strategy for using these cash secure puts to generate a regular income. In keeping with my channel, my strategy is actually pretty simple. Basically, I sell cash secure puts so that I'm able to earn 1% per week just by collecting the premium payments. Okay, now we're ready for me to jump in and describe each of the steps that I use to generate an income by selling cash secure put option contracts. Let's start with step 1. A successful cash secure put option trade begins by picking a good stock. It's actually pretty straightforward and simple for me. I like to find a company that has good fundamentals and a strong foothold in the sector or industry that they service. Additionally, I want to see that the chart exhibits some growth and success through the years. Now let's move on to step number 2. Once I've identified the candidate stocks, I move on to step 2 and actually use those stocks as the underlying security for selling a cash secure put option contract. Let's go ahead and take a look at a few examples from the past few weeks. And for each example, I'll pull the transaction record from my account history so that you can verify the contents for yourself. For this first example, it's for stock symbol VALE with the $14 strike price that paid me a premium of $26. And so my 1 week return on investment was 1.8%. This next trade is for symbol CHWY, and for this one I actually sold 3 option contracts with the $66 strike price that paid me a total premium of $300. So my 1 week return on the investment is 1.5%. Now that we've seen some examples where I've sold cash secure puts, let's talk about the last step. Step number 3, managing the trades. Now, because my primary strategy is all about making 1% or more in premium payments every week, I really enjoy the trades where the option finishes out of the money or at the money because it means that the contract will expire worthless. So I generally look to ride the option to expiration because I want to squeeze out as much profit as possible from the premium payments that I receive. But if the option ends up getting exercised, I'm okay with owning the shares for the trades because I think the company is sound, and I'll just turn around and use my newly acquired shares to sell a covered call and collect even more premium payments. And some of you more experienced traders will recognize that as a perfect setup for a wheel strategy, but more about that in a different video. But there's also some situations where I don't necessarily want to get the shares assigned to me, so I may end up closing my position by using a buy to close technique, which removes my obligation to purchase the shares and also frees up my cash that's reserved as my collateral. This next thing is very important, so be sure to listen and understand. I mean, it's extremely important that in order for this approach to work, it's critical to identify and utilize good stocks. Now, the ideal candidates are strong quality companies that are recently oversold. So I also look for share prices that are touching and rebounding from major support levels. And now for this next strategy, allow me a minute to get a little more comfortable before I explain it. Now, LEAPS is a long-term equity anticipation security. Basically, it's a long-dated covered call with an expiration date that's 1 year or more out. LEAPS options are a common investment used by traders to make money. I'm going to share with you a real life example of my own Leaps option. I'll give you all the details, the strike price, the expiration date, how much I paid for the Leaps option. Plus, I'm going to share with you how I made a profit of over 45% in less than 1 year. So if you're interested in making a profit of 45% in under a year, be sure to watch this video because you're going to learn how I do it with my Leaps option strategy. And once you see how simple it is, you'll be able to do the same exact thing for yourself. But before I go any further, let me answer a quick question. Some people ask me, what makes a Leaps option so different? As alluded to by the name, Leaps are stock options with 1 year or more until expiration. If you follow my channel or seen any of my videos, you'll immediately recognize that what I typically use for an expiration date when dealing with option contracts is usually weeklies or monthlies. But what makes Leaps options so unique, and depending on who you talk to, is that the expiration date will typically be 6 months or more away. But for my purposes, whenever I deal with Leaps options, I'm using an expiration that's 1 year or more away. So other than the longer expiration date, everything else about the option contract stays the same. Another question I always get asked is, what are the benefits of using a Leaps option? One of the immediate benefits of owning a Leap is that you control 100 shares of stock without having to pay for those shares. But wait, what does that mean? I don't have to pay for the shares. Let me explain it like this with a quick example using Apple Incorporated. So here we see 100 shares of Apple stock, and the current price is $140. So in order for me to actually own those shares of stock, my cost to purchase would be $140 per share times the 100 shares, which would equal $14,000. Now compare this to a Leaps option, where I would have the underlying stock being Apple Incorporated, and my expiration date would be a year or more away. So in this case, I've got January 19th of 2024, and I've specified a strike price of $140. Now, in order for me to own this Leaps option, which would give me control of those same 100 shares of Apple stock, my cost to purchase this Leaps option would be $29.80 per share, times the 100 shares, giving me a total cost of $2,980. So with ownership of this Leaps option, I didn't have to pay the full price for 100 shares, remember the $14,000, but instead I only paid $2,980, and now I control 100 shares of Apple stock that I can sell or trade. So with this lower cost Leaps option, I have the similar abilities just as if I had directly purchased 100 shares of Apple stock. Now that I've briefly discussed Leaps options and the huge price savings that are realized for controlling 100 shares of stock versus directly purchasing those same shares, let me now take a moment and describe how I make money with Leaps options. So here's the strategy I'm using to make money with the Leaps option that I don't often hear talked about. Now, even though this Leaps option has a 1 year expiration date, I actually make a profit before that. And in this particular case, I'm going to make a 45% return. And it's based off the philosophy of buying low and selling high. So I'm going to go ahead and buy and hold my Leaps in order to earn a profit. And basically, I use 3 steps. Step number 1. First, I identify the underlying stock that I'm going to be using for my Leaps option, and I want to find a stock that has huge growth and upside potential. Step number 2, I'm going to purchase the Leaps option and specify an expiration date that's 1 year or more out. By picking an expiration that is so far into the future, it greatly reduces the theta time decay of the option. Additionally, the long expiration, it provides a significant amount of time for the share price to rise higher, and the intrinsic value of the option will also increase. And as a result of the increased intrinsic value, it now takes me to step number 3. It means that I can turn around and simply sell the Leaps option for a profit. So as you can see, this technique is exactly the same approach that would be used for purchasing and holding direct ownership of stocks. So it's nothing new here, except that I'm able to take advantage of a stock and its appreciation without having to actually spend the money to own the stock. Here's the actual transaction record from my account history where you can see the Leaps option that I purchased. So I'm buying a call for stock symbol MVIS, that's Microvision Incorporated. It's got a $1.50 strike price and an expiration date of January 20th of 2023. Now I submitted this order on January 20th of 2022, so you can see that this Leaps option has exactly a 1 year expiration date. It expires 1 year from the date that I purchased it. Now it was filled on January 20th, 2022, early that morning at 6:47 a.m. Pacific time. And at that time, it was paying $2.40 per share, which means when this option contract got filled, I received $240 as the premium payment, and that showed up as a credit deposited immediately into my trading account. So at this point, I now own this Leaps option, and as the Leaps owner, I can now hold it, or I can exercise this option, or I could sell it. Here's a daily trading chart for stock symbol MVIS, and if we look at the date March 1st of when I purchased this Leaps option, the stock price was hovering right around $4.20 per share. Now let's take a look and see what the industry analysts think about this particular stock. Well, there's only one analyst, and they give it a hold rating. So, in other words, if you don't own it, don't buy the stock. But if you do already own it, don't sell it. So, in other words, hold on to this stock. And this analyst gave this stock a one-year price target of $5 per share. So for me, when I purchased this Leaps option back in the beginning of March, March 1st, and the stock was trading right around $4 and $4.20 per share, it only had another dollar or so of upside potential. And now if I fast forward to the end of March, we can see that the stock is actually trading at $5.05 per share. So at this point, it's already reached the one-year price target that the one analyst had estimated. Now, the company itself has a market cap of $831 million and an average share trading volume of just under 6 million shares. So I feel there's plenty of liquidity here. Lots of people buying, selling, and trading this stock. And now if we go back to the daily chart and we look at March 29th, the day that I actually sold my Leaps option, let's take a look at the share price. And you can see that on that day, the share price had reached a high just under $6 per share. So this was easily over the industry analyst estimate. I also didn't think the stock would reach this high of a price so early. And so now I was faced with the decision of whether or not I should maybe exercise the option and actually get assigned the shares, or maybe I should just sell the Leaps option for a profit. Well, as you can guess, that's exactly what I did. I didn't exercise the Leaps option. I actually ended up just selling it and collecting a higher price than I had paid for it. So what actually happened and why did I decide to sell? I was concerned that the price of the shares would drop. The price had gone over the analyst estimate, it had gone over my estimate, and it appeared to be in an overbought condition. And so now let's jump forward to March 31st and actually take a look at what happened. So we can see here on this daily chart, March 31st, the stock price closed at $4.67. So sure enough, the price did drop from its high from March 29th when I actually sold my Leaps option. Here's the actual transaction record from my account history, where I ended up selling the Leaps option. You can see that I sold the long-dated call for symbol MVIS that had the $1.50 strike price and the expiration date of January 20th of 2023. Now, I submitted this order on September 29th, and it was filled that morning at 7:30 a.m. Pacific time. So roughly the beginning of the open, or within the first hour or so of the opening of the market. Now, at that time, it was paying $3.50 per share. And so when my sell order got filled, I actually received $350 as the premium payment in order to sell to the buyer my Leaps option. So now let's take a look at what happened. On March 1st, I purchased a Leaps option and paid $240. And then on March 29th, I ended up selling that same Leaps option, even though it hadn't reached 1 year yet. But I sold it and received $350. Which means my net profit was $110. And so that means I got a return on my investment of 45.8%. Now, I hope that these strategies that we've discussed so far have been helpful to you. But what if I could help you even more? I've got several other strategies that we haven't even discussed yet. Would you like to learn even more? Now, you can take what I've already shared with you and start making money by options trading. And you can do it immediately starting today. For example, if you already own 100 shares of stock, you could use those shares to sell a covered call and collect premium. Or maybe you don't own 100 shares, but you've been thinking about it. Why not sell a cash secure put, pay the price you want to pay for those shares, and collect a premium on top of that? But maybe you're still a little bit hesitant, you've got a few more questions, or you're not quite sure about the details yet, and you'd like to get more information. Well, then why not join my Discord and have direct access to me? That's right, I answer questions directly. I even share my stock picks, give entry and exit points, and also trade alert notifications. And in this trading community, you'll find there's hundreds of like-minded individuals just like you that share information and give each other helpful hints so that we can all be profitable in our option trading. You can join my Discord today by going over to discord.simpleoptiontrading.com. I'll leave a link in the description below. So if you're ready to start making money today, or you've still got a few more questions, why not join my Simple Trading Room Discord community so you can ask me questions and get more information. Also find out about my stock picks and my trade alert notifications. I hope to see you over there.